So let's take a look at what happened today in the market. So as we know, right, from the market analysis I posted yesterday on all three indices, we were looking for higher prices. So we can quickly break down kind of what I did yesterday and why I was looking for higher prices on the indices. Now recognize today is a Monday, right? So if we have the expectation for the weekly candle, right, in this case, let's go through that quickly, right? Our weekly thesis was using this internal range of liquidity with this daily SMT on the ES, the NASDAQ, and the YM to reach back up in to this external range of liquidity on the weekly. So this is a simple IRL to ERL move on the weekly chart. And what we noticed on Friday, the key observations that we made were several. First of all, we noticed that the ES was seemingly stronger as we had closed above this previous weekly low. So if this would be the previous week low, not daily low, right? We see that, where is it? Oops, right here. My apologies. The ES actually closed above it, whereas the NASDAQ and the YM closed below the previous week low. In addition, what we can see is that a bullish kind of narrative or confirmation for all the indices was the holding of this weekly change in state of delivery level, right, on the NASDAQ, closing in that upper quadrant of the same order block on the ES, right at that 25%. And then also that daily SMT, which we noticed. So we had a couple of PD arrays of interest on our weekly chart, which was going to be 1, this breaker, right? 2, this change in state of delivery or order block. And then 3 is this internal range of liquidity, all of which gives us a bias to look for longs this week. Likewise, on the dollar, you can see that we are reaching in on our higher time frame charts into external range lows. So we can see that the market in here traded into this inefficiency, right? And it's permissible for us to trade outside of the boundaries of this single gap, right? ICT mentions that we actually do come into this redistributed, rebalanced area of the chart, and this is where we actually find resistance, right? So on a lower time frame, this is going to look like an inefficiency, right? Like this 4-hour fair value gap, and on the higher time frame, like the daily, it's this redistributed, rebalanced area of price. And also, right, the bodies are holding this level here, right? This wick, which overlaps it, which is going to be the order block, right? This wick is what we care about, not necessarily the body like in many cases, simply because the wick overlaps this inefficiency, and the bodies here tell us a story of how we are finding support. If we also draw out the consequent encroachment of this RDRB, or if we refine that down to the 4-hour to the inefficiency which it overlaps with, which is this 4-hour fair value gap, we can see that price is showing an unwillingness to close above it, and instead offering a 3 drives like pattern, right? Progressively digging in higher once and twice, and this, I guess, the first time, so 2 distinct drives once and twice before selling off. All right. Notably, what we can see is that in this price leg lower, we have sell side liquidity targets on the dollar, right, below this low, which is a weekly swing point in the market. And then also we have a failure swing down here, right, and a weekly inefficiency which overlaps it. So we can be monitoring price as we draw into our liquidity levels to see if price wants to trade lower, potentially into even this weekly swing point, right? Or if price wants to find support in this level. At the moment, we're just saying that the price is going from this weekly order block, right, this daily level, back down into these sell side liquidity targets. Interestingly enough, we can also utilize the fact that once we offered fair value, right, into this low, price actually disrespected this inefficiency and is seeking the alternative side of the curve's liquidity. So instead of offering fair value and then reaching in to buy side liquidity with relative equal highs, right, we instead fail to offer fair value to move higher and instead invert this PD array, right? And now you can see how it starts to offer resistance along with this weekly bearish order block, right? So that's kind of our time frame alignment, and we can now see that price is going lower. We see a similar story, right, inside of this daily fair value gap, wherein we fail to offer a reaccumulation of fair value to move higher and run against these failure swings in the market. But instead, right, we now have come back in, retested this bearish area, and are now moving lower. So we now have qualified with this strong body candle closure today, the potential for this to act as an inversion fair value gap in the market. So we can refine our levels, right? And we want to see how price now reacts to this level as well, right? I'm going to delete this box since we know we're inside of this weekly fair value gap. Okay, let's go back to the indices. So on the indices, what we can see, right, is a complementary argument reaching to the other side of the range, and that is largely how we've defined our bullish bias. On Twitter, I posted about all the confluences that I was looking at, so you can go in and review that after if you want a little bit more context. So now let's look at how today trades, because today, moving into the day, we have a very distinct point of interest to consider, at least on the S&P or the ES, right? So on Friday, I said we want to see this inversion fair value gap offer support, and I would not want to see a daily body candle close below the consequent encroachment ideally, but we wouldn't want to see it close below the fair value gap as a larger area of interest. So not only today do you see how the market offers discount arrays on lower time frames within this displacement leg, but it also closes not only above the consequent encroachment of that daily inversion, but also above the gap itself, which is an incredibly bullish signature. Likewise, we see how the NASDAQ draws in to the previous day equilibrium, right? So if I take the low of the previous day and the high of the previous day, and I draw out that dealing range, we can see that we reach into 50% of that dealing range, right? We can even look at that, and you can see how we've offered a discount of the previous day's high to low, wherein inside of this discount, there's going to be a lower time frame array being offered. As you can see, the narrative here is quite clear, with us respecting the 4-hour fair value gap, right, on the ES. And on the NASDAQ, we are respecting this 4-hour, right, new day opening gap, essentially, this volume imbalance. And on lower time frames, we're going to see even more PD arrays, right, such as this balanced price range or this inversion area. Again, the consequent encroachment is being well respected. Likewise on the ES, right, we reach into, so in here there's several PD arrays of interest. Now, in the ES, the reason why we are more bullish is because we have closed not only, right, above the previous week low last week, but we also closed and broke structure above these highs, something that NASDAQ has failed to offer at the moment. We still have this SMT inside of what we believe to be this inversion candidate for the NASDAQ, right? We have yet to inverse this daily SIBI, so at the moment it's still just an inversion candidate. Whereas on the ES, as you can see, we close through that daily FVG and we're looking for it to offer support, and then we get into an area of very high confluence to go long. So if I draw out a dealing range once again, right, and we look at the equilibrium of this range, you can see how ES trades into the equilibrium, but not just the equilibrium. Once it trades into that equilibrium, you can see, right, how the bodies are finding support at the PD arrays, which overlap this key level of equilibrium. There's 3 PD arrays of interest. We have this large up close candle, which we know to be a breaker. Now this breaker overlaps this fair value gap, which is a hourly BISI. And then in addition to that, we have this change in the state of delivery above all of these up close candles, which can be seen on the 1 hour and the 4-hour charts respectively. The 1 hour, it looks a bit nicer because we have these 3 consecutive beefy down close candles into our key level with smart money technique with the YM and the ES at these lows last Friday. And then once we retest this area, there's 2 areas we are definitely going to care about inside of this order block, right? So we can mark out the order block. We care about the open and we care about the consequent encroachment. So we can look, or the mean threshold rather. So we can look at both of those levels and you can see that price holds above both of those, and more specifically tags a very, very precise level, which is this inversion fair value gap, right? So this inversion fair value gap is the part of this large inefficiency that price refers back into and then finds support at all of these arrays. So this becomes a high resistance liquidity run to come below here because we have this jagged edge. Now we've retested it and we can expect the delivery of higher prices, which is what we got in the PM session. So there's a lot of confluence in this area and there's a lot of context arrays you could have chosen, right? In addition to this inversion fair value gap, right? That's referred to again. So there's many different arrays you could refer to in this area for price to be offered support, obviously with the ES being the strongest. So now we can break down exactly how price delivered this daily power of 3. So if we are expecting, and I'm gonna put this back here as an inversion candidate. So it's not yet an IFVG, but it's an IFVG candidate, which is why I'm principally looking at the S&P or the ES for longs this week, simply because it's giving me the strongest bullish indicator. Again, right, look at the daily candle closure here. We get a close below the previous day high on the NASDAQ and a strong close above. Oh wait, we actually don't get it. My apologies. Whoops. We get a close below as well on the ES. All right, I thought that the ES closed above here. The daily candle still closes below, my apologies. But we get a closure above this inversion fair value gap, which was that key level that I noted, right, on Friday. So here we still want to see if the NASDAQ is able to reach up, use this as support, and then move higher. The current expectation that I am assuming is going to be some form of divergence at this external range weekly high, right? So moving from internal to external based on this weekly candle close and then the inversion being created, there's higher resistance liquidity in the move on NASDAQ into external range highs because we have this up close candle, which may offer resistance now in the form of an order block on a lower time frame, which we can see was that daily change in state of delivery, right? Right below this candle. Look where the body closes, below it, which is important to notice, right? And we still are respecting this SIBI, so it's not an IFVG yet. So let's look at the daily power of 3 and see if it can map. Also, one last thing to notice in the daily chart is we have these devil's marks, right? A devil's mark is a candle that opens with no wick. So if we assume every candle has a bearish candle has an open, high, low, close, this daily candle opened, right, immediately declined and then closed, meaning it was yet to price in a wick, right, to the buy side. So there was no liquidation of any form of premium liquidity or arrays tapped into here. It was simply an open decline close, which is going to be a strong target when price action reverses on the other side of the curve because there's going to be liquidity that rests above that candle high. Notice how the YM puts in an equal high to that devil's mark, which is also an interesting observation. And we can also draw in this daily inversion on the YM as well, right? So we can see that level, the consequent encroachment, is also being respected on the YM. Okay, so that's our daily look. Now let's say what happened today and how could we have engaged in price. So given our weekly expectation, which is going to be, right, internal to external, we now view the weekly candle as a power of 3 move itself. So we would expect that every candle, if I pull up a higher time frame candle right here, like the weekly chart, and I just look at one weekly candle, right? Perfect. So as you can see, every candle is fractal, and we anticipate the formation of an open, low, high, close for a bullish weekly candle. That would correspond to a candle that looks like this, right? It closes, it opens here. So let me actually draw that more proportionally. It opens here, closes here, and we offer manipulation to a key level with SMT, and then we distribute to a key level before closing, right? So this is the open of the week, which we can see here, the low, the high, and the close. And these areas are bounded by the context or the narrative associated with where the low and the high should be formed. The high should be formed at or around the external range liquidity that we were expecting. It may close higher. If it's a bullish expansion week, it may close near its high, which is a very common thing for expansion candles, is to close near their high. However, we have an area to evaluate where the high of the week may be put in, and then the low of the week, right? We do not expect, if we are bullish, specifically, right, on the S&P. Maybe not this argument doesn't apply to the same extent to the Nasdaq or the YM, but specifically on the ES, because we have formed this SMT divergence inside of this weekly gap and then closed bullishly through this inversion, we do not expect a candle body closure through this intermediate term low. So we expect this candle low to be offered, to not be offered as liquidity for this current expansion move higher. What we want to see is price trade from its opening of the weekly candle down to a level that is not past here, right? Then expansion followed by a close. So if I draw out that same weekly candle on the ES, right, we can see exactly what I mean by that. We are looking to see if this weekly candle now can preserve this move lower, right? The open low. Now we want to see it reach into the high and close. We expect this to be the weekly manipulation, which we can see here is into a key level, right? Daily order block, daily inversion fair value gap. So in order to qualify the idea that this weekly candle that we are looking at right here has already formed the low, at least until we liquidate the external range high, right? We could alternatively reach into the external range high and then completely reverse. It's NFP week, so it's lots of volatility in the market. But to make the assumption that this weekly candle has already put in the low, we need to see two qualifications for this reversal down here. And those two qualifications are going to be a higher time frame PD array and an SMT divergence. So what we can do is we can now scale down a time frame, looking at the 4-hour chart, for example, or the 1-hour chart, to see if that context is met to qualify this as our low, such that price does not need to come back below the inversion fair value gap and now can expand, right, to this external range high. So let's go down a time frame and see if that happened today, Monday, June 3rd, right? And then let's also see if we could have taken a trade around that idea. So opening up the day, you can see, based on the same idea we're talking about of opening high-low close, right? We have generated a significant amount of low resistance liquidity to the sell side. We are also opening up the day, right, in the New York session, failing to close above the true day. The true day is offering us resistance. So we can see that this daily candle looks something like this as we open. Open, small manipulation higher, right? True day open, not 6 p.m. Then we decline, sell off before closing. So it's an open, high, low, close. Now this in here is not the trade I would have taken this morning, right? Despite seeing the resistance offered by true day and despite seeing the sensitivity to this hourly order block, right? This would have been a nice area to consider shorts from. However, I wasn't interested in that, seeing that my higher time frame directional bias was long. Instead, I wanted to evaluate if price could reach in to our context area, which we'll mark out by this big gray box. This is our context area. I wanted to see if price could reach into this context area to offer some sort of long setup, because again, I do not want to see price close below this low or even liquidate that low. I think this is a balanced price range, right? V-shaped recovery. So I would not want to see price trade through this order block, through this fair value gap, through this breaker block, right? So all of these PD arrays, 3 in here, right? 1, 2, and 3 in the breaker, and the inversion, and 4, I guess, is the inversion. I want to see hold price higher. So I will wait for an opportunity to align myself with my higher time frame order flow. Again, what I'm seeing in the market, like I talked about last week, is these failure swings. I want to target this liquidity. I'm not interested in the manipulation lower. I'm interested to see if I can trade alongside my higher time frame bias, which is expansion legs higher. I see this as an accumulation. I see this as a manipulation, and I want to see if I can align myself in with the power of 3 distribution, in line with the daily candle direction, which I wanted to be bullish. So as we come into here, I need to qualify that seeing my time frame array, higher time frame PD array SMT right in here, this hourly, 4-hour, daily level that we're talking about overlapping, and also the key level SMT. So in here you can see that we formed this SMT with the Dow. Now it doesn't look like a regular SMT that we are used to. I'll also mark it out on the NASDAQ. Right? This is not a regular SMT that you might be used to seeing. A regular SMT that you might be used to seeing would be an external range low being the area of SMT. What we have to recognize is that a higher time frame array, such as this, fair value gap, right, is going to be a lower time frame consolidation or external range low above it. So this is what's referred to as a PD array divergence or a lower time frame SMT, right? There you go. So we can see the SMT formed at an external range low like we're used to observing. However, in the context of this hourly chart, a PD array divergence, this fair value gap right in here, this divergence, I can also see as an SMT, knowing and understanding that it is a lower time frame, external range low SMT divergence. So as we see that, right, now we have the ability to frame the potential to go long. Another thing we might want to look for, right, is to evaluate if this manipulation lower can be mapped, or it can be anticipated, right, where this terminus is based on power of 3 concepts. So just as we said earlier, right, that a reversal in the market will require 1, a higher time frame PD array, or in this case, overlapping arrays. Right, we have about 4 of them on different time frames that we're looking at in this area, and an SMT. We can also use the same logic, right, to use to map the manipulation leg. So if we assume that this reversal short term, right, so in here we have accumulation of the market, deviation above the highs, which can be seen as manipulation, and then distribution. This higher time frame reversal, look at a 4-hour chart, higher time frame reversal is the same thing as a lower time, or higher time frame retracement is the same thing as a lower time frame reversal. So what we can do is we can frame that reversal using power of 3 context and look for those 2 things. What was our higher time frame array? Well, as you can see on this 4-hour chart, as a good example, we have this internal range of liquidity on the ES, so I can mark that out. We also have that same internal range of liquidity on the NASDAQ in here, right? In addition to this daily fair value gap, right, that NASDAQ has yet to trade through, and this 4-hour redistributed, rebalanced array, which we're going to know to be on a lower time frame like the hourly, a fair value gap, right? This fair value gap right in here, and then this higher fair value gap right in there. So we have a context area, right, for a potential reversal. Now we need to see an SMT. So there's the fair value gap on both the indices. Right, I'm not looking at the Dow right now as much. I want to look and evaluate these 2 indices because they're more closely correlated. Now what we'll see is we have an SMT that forms inside of that array. That's going to be this key level SMT right here. So I will mark out equal highs on the ES. I'll make this much larger so you can see. These are equal highs on the ES. And this is a higher high on the NASDAQ, right? Now this is inside of this higher time frame SMT we're currently observing, wherein the ES has traded, above the daily fair value gap, right? And the NASDAQ is still well below it. So now we have, right, this higher time frame bearish divergence with the NASDAQ, and then we have this lower time frame, right, bearish divergence with the ES failing to make a higher high. These 2 SMTs in here, right, these 2 SMTs, right, are higher time frame, lower time frame SMT, higher time frame, lower time frame SMT. These can qualify our short-term reversal. And remember, the expectation for the day is for the weekly candle to offer an open, low, high, close, right? We want the weekly candle to offer this low, right? So that we can expand towards the high. So we don't want to see Monday trade like this towards the high, or else we are likely to see an open, high, low close, wherein we might liquidate the high and then reverse against the opening price, right? So this is exactly what we wanted to see. We wanted to see this power of 3 form, giving us a decline that we could rally against for the rest of the week, right? Targeting the buy stops, the failure swings, and ultimately our external range highs. So we wanted to see this today, which is why we weren't surprised when we saw that large morning sell-off, even though I said I wasn't going to trade it because I was waiting for this to form. Now let's see if we can use a power of 3 concept, right? Inside, let me make sure no questions. Let's see if we can use a power of 3 concept inside of this expansion leg lower, which is a higher time frame retracement, to pinpoint the reversal area. So what I'll do is I'll use this hourly high, which is the clear manipulation, and I will drag it, right, to the low of that last manipulation leg in the market. The 15-minute chart will show you even clearer exactly where that is. It is this last manipulation higher before price sells off and moves lower. As you can see, price trades into our 2 to 2.5 deviation level, forming an SMT. This is a high probability retracement reversal area, and for me, knowing the context that we're talking about on the daily chart, right, on the weekly chart like we spoke about, knowing that context, I'm more comfortable assuming this is a reversal area and not a retracement area, meaning I do not expect this fair value gap in here to offer resistance. I would rather see a full reversal from here. Likewise with the ES, I would rather see a reversal through this inefficiency, not a price move that looks like a retracement into it. That is the key differentiating factor between using the 2.5 area for reaccumulation or using the 2 to 2.5 area for reversal. It's the higher time frame narrative, which we know to be from our higher time frame charts, bullish, right? We talked about it from a weekly perspective to a daily perspective to our 4-hour, now down to our hourly manipulation leg. Let's use the same manipulation leg on the ES, accounting for that SMT divergence, and we can see that ES reaches into the terminus of that price leg, which is the 4th deviation. Again, forming SMT inside of these key levels. Likewise for the Dow, right? We can use, whoops, that's the wrong day. We can use a similar projection. And again, you get that 4th deviation reversal from terminus. So all the stars, right, are aligned, so to say, if the lower time frames can show me, right, that price is willing to change delivery state, keying off of this discount of the market. Again, all of this happens in discount, right? It's important to consider that all of this is happening in a high probability area for reversal. Not just the power of 3 standard deviation projections, but also being in discount of the dealing range in higher time frame bullish order flow. If the lower time frames can offer me some sort of change in state of delivery and entry signal, right? Some pattern, if you will, that's based on the context, I would have no problem engaging in a long, which I did in the PM session. So now I will utilize just a regular time frame calibration. So I'll say that this in here is my hourly BISI. I'll mark it out on both of the ES and the NASDAQ. And today I traded the NASDAQ as opposed to the ES simply because I saw something I liked more on the NASDAQ, and I'll show you what I saw. So dropping down a time frame. Sorry for all the colors on my chart, right? There's lots of key levels in here that are from the higher time frame that are kind of overlapping, but bear with me, right? The YM was not as much of my consideration after I saw the SMT divergence. Now, the YM wasn't my consideration, right, for higher prices to trade simply because it dropped the lowest, liquidating this low, meaning it's showing the least relative strength on the higher time frames in comparison to the two indices that made much, much higher lows inside of my key level of reversal. So I was really zoomed in on the S&P and the NASDAQ. And what I saw in here, right, when I zoom in here after the SMT forms, which is right down here, what I see is this change in state of delivery. So price declines with consecutive down close candles into our key level where we form an SMT divergence. So this now becomes my change in state of delivery on my 5-minute chart, which is also equivalent to my change in state of delivery, right? The same area on my 10-minute chart, and my 15-minute chart actually wouldn't be till up here. So it's the 10-minute and the 5-minute chart, right? You can use whatever chart you like, whatever gives you a better indication of these consecutive down close candles, right? So I'll mark out both of those. Let's mark it out right here. In fact, I'm going to use the 10-minute chart because these are all meaty consecutive down close candles. And on the 5-minute chart on the ES, you can see that there's this small up close candle in the way, right? So I would prefer to use all of these candles. So I'll just filter up to a time frame where they're all one consecutive delivery state. So now I have my change in state of delivery. I can go back to my 5-minute chart, right? Below. So I also have a breaker which overlaps this. So below here, I can now start to frame these as breakaway gaps. I don't need to see price necessarily trade back in to this inefficiency right here, this 5-minute BISI, nor this 5-minute BISI. I don't need to see price trade into it, right, to consider higher prices. What I want to do is I want to evaluate order flow as price creates this displacement leg, right? So you can see using the third candle method, which I've taught, this fair value gap is a good candidate for a breakaway gap, as is this fair value gap, right? Closes above this third candle, and then we have another third candle here, which closes above here. So this is a large displacement leg. Now, when I see a large displacement leg like this creating multiple 5-minute gaps, my mind intuitively is going to go, okay, I want to find the time frame in which there's, one fair value gap in here to see if we retrace into it. So I'll go to the 15-minute chart. And for me on the 15-minute chart, what I see is very nice. I see this nice 15-minute fair value gap right here and 15-minute fair value gap right here. Now, I also see this much smaller 15-minute fair value gap right here as well. And right here as well. And the reason I'm very confident in this 15-minute fair value gap being retraced is based on the third candle method again. So look at the differentiation between a gap like this 5-minute fair value gap in here, which we will call a breakaway gap. I'll make it a different color. All right, let's make it purple. We have the third candle close strongly through, right, the second candle, meaning is price more or less likely in its delivery to reach above with displacement and then come all the way back down before going higher, or is it likely to continue displacing higher because we're forming, right, breaks of structure on lower time frames? This is a break of structure. Whereas on the 15-minute chart, right, in that same logic, it's fractal, we can see that this third candle closes into this PD array, 15-minute SIBI, and then this candle actually closes below the second candle, right? 1, 2, 3, 1, 2, 3, right? Now I have a good indication, right? This actually swept and then closed below, which is even better because this forms, again, it's all fractal, an SMT divergence at the high. Now, it might be hard to see that on the 15-minute chart, but if I go down a time frame, you'll be able to clearly see this is the area where that short-term reversal begins, right? Short-term reversal is a higher time frame retracement, right? Retracement into this 15-minute gap is going to be a 1-minute market maker sell model. And I'm using the same logic, right, about SMT divergences at higher time frame arrays to frame the sell model into our arrays of interest. So as you can see, right, I have both of my 15-minute gaps marked out here. I'll just drag them over to the left. Now I'm looking for a reason to get long, right? I've seen my change in state of delivery. I've observed it. Now I want a reason to get long in the market. As price comes into this 15-minute fair value gap with something called institutional order flow entry drill, where it just taps the open, I see the signal I need, right, to get involved in the price leg, which is going to be exactly what I talked about before. I see an SMT inside of the PD array. Right, so here's my bullish SMT again with the ES, which confirms to me the relative strength of the ES, right? So I now know that the ES is relatively stronger and will probably reach up higher, okay? So for me, the only reason why I traded NASDAQ here is because NASDAQ at this point had put in a failure swing to this high. I'm going to mark it out in the blue line. And the ES had liquidated that high with this move. So because I was only trading a fractal from here to here, my first TP, and then from there to there is my second TP, I knew that this high had yet to be liquidated on the NASDAQ. So I liked it more because the ES had already swept it. As you can see in the end, the ES was the stronger pair. It made a price run into higher highs, right, all the way up here. It came higher than the NASDAQ, which makes sense because it's on all time frames from the daily, 4-hour, hourly, weekly, all of our time frames. The ES has shown us bullish divergences in comparison to the other indices, right? And it closed above the previous week low. So it's showing us a reason that it wants to move higher because it's created this inversion. Again, on the daily chart, it becomes very clear, right? Look at where this candle closed in relation to this inversion. Now, in the lower time frames, I just saw there was low-hanging fruit on the NASDAQ, so I traded into that. So once I saw this SMT divergence, right, inside of my key level, I took my entry just in that, which also corresponds, right, to this 5-minute fair value gap or this 5-minute fair value gap, and I like to take entries usually on the 5-minute chart, so I didn't feel the need to refine this down any lower time frames. I was more than comfortable entering, targeting this high and this high, so the position looks something like this, right? You get an entry when you see the SMT form, and your first target gives you a really nice trade of like 50 points, and I'm risking, right, just this low. I don't want to see this gap get traded through, and I definitely don't want to see us come below this what I'm calling this breakaway gap, because we have this order block, right? We have this 15-minute gap, we have this 5-minute gap, and we have this inversion gap right here, right? Which again, all of these things are providing support for price. So I will keep my stop loss as a candle body closure through this low. If it wicks, that's okay, because it might not, this small gap might be refilled, but I wouldn't want to hold it into this area unless it quickly distributed lower, in which case I take a larger loss. So my loss is a candle body closure through here, which is roughly a 2-to-1 R trade. Right? It's a 1.94 R trade to the first TP, and then obviously your second TP is going to be up here, right? With extended targets if you were trading a one-shot, one-kill model all the way up, right, to the previous day high. Or in this case, the daily high, because we're thinking about the dynamics of opening low, right? In this case, opening high, low, close for the day, but this is inside the weekly move, opening low, high, close. So we expect this to be low-hanging fruit for the weekly objective. The weekly objective is now going to be to trade much past, this opening high. Right? This day looks like this with an opening high, low, close, and the weekly chart can still keep moving higher. So if you were swinging, for example, you'd be taking profits above this high, right? Which is a higher time frame target. So that's kind of how you can align yourself with order flow using, top-down analysis, a very simple entry model, right? Very simple entry technique. It doesn't have to be complicated. And if you want to refine this area more, there's many ways you can do it. So you can wait for us to come into this gap, and you can choose to go down a time frame. Maybe look at your 1-minute chart and you want to see something, right, in this price leg lower. You want to see some sort of evidence that we are going to be reversing. So once you see the SMT form, you might say there is a set of consecutive down close candles in here which has several inefficiencies. Once we invert perhaps the most premium inefficiency of this market, right, if you want to be very, very concrete about your bias and you don't want to short into these SIBIs, once we close through here, you can say, okay, right, this is an early market structure shift. Here is another short-term market structure shift. You can choose to get involved in this PDA right here, for example, right? This fair value gap. Again, you want to be risking the low of the SMT, and you still want to be targeting that high. Now, for me, I was more comfortable utilizing the higher time frame context, right? That I didn't need to refine my entry zone excessively. I knew exactly what I was looking for, and I was offered exactly what I was looking for in a time where it made sense for the market to expand, right? And that time was the PM session. So if we go back to a lower time frame, you'll see, right? The low of this price move forms at, let me pull up a price label. The low of this price leg happens at 210, right? Which is right inside of our macro, right? Which is going to be 150 to 210. So let's go 150 to 210, which is the, right? There we go. Right, which is the last 10 minutes of the previous hourly candle close, the first 10 minutes of the new candle open inside of our silver bullet, right? ICT silver bullet time. And again, we can use the same concept we use for the manipulation lower. Remember, the manipulation lower looks something like this. Right, this last leg on the 15-minute chart. We can use the same idea right here to frame this move higher. So we see this last context right here. The last context of this move was manipulation. So we can, extend that higher in time and use those for targets, right? So we can see that our buy-side liquidity right here lines up with this tier 2.5 region, and then we have our first reaccumulation happening in between this liquidity and this liquidity, right? And the same thing goes for the ES using power of 3 concepts. You're looking for that last manipulation leg, like that, right? And you can see that the ES, the 2.5 lines up with the true day, and the 2.5 lines up with our liquidity, right? So it's a very nice target for us to use a confirmation tool for. The last thing I'll talk about, right, briefly, is the idea of a 4-hour power of 3. So we talked now about the weekly candle wants to do this. Opening, low, high, close. This low, right, is coming off of a key level. After last week, we confirmed, right, that we have a reversal in the market. Again, look at the last week's close. The last week here with this large wick lower and then closure back above says that we want to reach into the external weekly high. So we don't expect to come below this weekly low. That would not be the most bullish indication. We'd want to see price, right, trade not below this old weekly low. We can actually look at areas inside of this weekly candle, such as a discount of this wick, something that looks more like this, to see exactly where price did reach into. Right there. Let's see on the ES where we reached into. Right, ES reached into the 50% mark of the previous wick low, or the previous wick open of the body to the low. Very nice, because the consequent encroachment of a wick is going to be a lower time frame inefficiency, which we know. So we don't want to see this wick be closed through. It wouldn't make sense. We don't want to see this wick even be traded to. So now we can look at how the weekly candle wants to go open, low, high, close, with the Monday offering the low, right? Monday offering the low. And the daily candle, right? Because of that expectation, we want to see on the daily candle an opening high, low, close, closing back in the range, forming the low of the opening low, high, close of the week. I hope that makes sense. This might be a bit complicated. What I'm trying to say is the weekly candle wants to go open, right? Low, high, close. And the daily candle wants to align with this narrative and then open, high, form this low of the week is going to be the low of this Monday, for example, then close back within the range, right? Which we saw it do right here. Perfect. Now we can apply the same idea of opening, low, high, close to the 4-hour candle that opens at 2 p.m. So where in relation to the higher time frame move, right? The context, which is IRL to ERL, is the 2 p.m. candle opening. Well, as you can see, right, we can use standard deviation projections like we talked about. Yes, we can say, look, right, the 2 p.m. candle opens up inside of what? Like, let's mark out our 2 p.m. open. So our 2 p.m. candle opens, right, after we have liquidated the lows inside of our retracement reversal area, right? We said that's our retracement reversal area. And then we can go down a time frame and say, okay, so where does this open in this shorter time frame power of 3? Let's look at the 1 minute projections and see if we open up in the silver bullet zone for an expansion. Right, look, the 2 p.m. open is inside of this, right, lower time frame expansion, this reaccumulation zone. This is the silver bullet reaccumulation zone. So we expect price to open, form the low, form the high, and then close. But you don't need to use standard deviations, right, to tell you what the 4-hour power of 3 is going to do. Simply look at where we are opening in respect to the daily open, high, low, close. Daily candle, right? Open, high, low, and we've already formed this wick. So as 2 p.m. opens, you can see that the internal dynamics of this wick have offered us, right, something that looks like this. And we've started to trade higher. So now when the next 4-hour candle opens right here, we can expect open, low, high, close. A continuation of the reversal we know is happening on the higher time frame. Okay? So with the higher time frame is already showing us a reversal at the 2 p.m. candle open. So when we mark it out, right, we'll do it on the ES because the ES was stronger, and I did suggest trading the ES. So as the 2 p.m. candle opens, we already know where we are in relation to this daily power of 3, right? The daily power of 3 starts here, high, low, and we've already formed the low. So we're coming off the low, and we can now expect 2 p.m. to open, low, high, close. Back in the range, right? Perfect. Using that narrative, using our higher time frame thesis of what price should do, as the 1400 or 2 p.m. candle opens, you can see exactly how that interaction works. We decline on the open of the 2 p.m. candle, right? We decline into our SMT. There's our SMT, right? Once we decline, we've now formed for the 4-hour candle, the wick. So in your mind, you're now seeing this 4-hour candle that looks like this. So here's the open, right? Oops. Here's the, I need to turn my magnet off for this. Here's the open, right? That's going to be the body low. And we're expecting an expansion of this 4-hour candle higher. Now this move below is just the manipulation. And you can see the manipulation is confirmed with the SMT. So we have an open, and then what does this look like, right? What does this actually look like? Open, low, high, close. This power of 3 is a high probability fractal of the entire daily power of 3 that is occurring. That is why the AM session decline was not preferred, because I did not want to trade against what I believe to be the lower resistance move in the market, going long, right? The higher time frames are telling me my bias, and that is long. So there's where you can position yourself for that next 1400, 2 p.m. power of 3. In the same way in the morning, right? If you were shrewd and you recognized what was happening, you could have positioned yourself for that 10 a.m. power of 3 lower. So look at the 10 a.m. candle. We'll mark it out. This is the open. Go on to a lower time frame. Sorry, this is the open right there. Perfect. All right. Let me drag this in. So this open, I'll make it a different color, like red. You can see we open, and where are we in relation to the daily power of 3? Like, yes, again, you can use lower time frame projections. So it is more than possible to do something like this and use a projection and say, look, we hit the 1 to 1.5 region. This is the silver bullet reaccumulation zone, right? And then we delivered all the way down to 4. Look, 4 so nicely layers up with that terminus of this price leg. But you don't need to use the projections alone to confirm that. This is a nice confluence, yes. But if, again, think of the daily candle has opened at midnight, true day open, right? We can use 6 p.m., but we've opened true day, right? Chopped around. But let's look at a higher time frame. We've opened. Now we've formed a high. Now we've traded lower. We are inside of this expansion. So now we open the 10 a.m. candle with a retracement. That's how the daily projection looks, right? The daily power of 3. So when we are inside of this area at 10 a.m., the draw on liquidity, right? As you can notice, we form equal lows on the ES, which is a very nice indication of order flow and where it's going to reach into. But you can see that once we open, we form the high right on news, right? 10 a.m. News reaches up, stays below the inefficiencies right here. Let's look and see if we form any key level SMTs. Again, like we talked about before, right? We want to see open, low, high, close. 4-hour candle, which is a part of the daily open, high, low, close, which is a part of the weekly open, low, high, close. All of it is power of 3. Here we form the SMT inside of that 4-hour manipulation higher. Right, let's mark out 10 a.m. Right, there is our SMT divergence with the Nasdaq and with the Dow Jones. Okay. More importantly, we are respecting the order flow that is trading lower. Right, and you can see price comes back into this fair value gap. This change in state of delivery, which overlaps this fair value gap, and then we trade lower. Same thing is happening in this 4-hour power of 3. If you go up, you'll see, 10 a.m. candle, you can see exactly what it does. Open, high, low, close. And then 2 p.m. is open, low, high, close. And then the daily, right, just to hit it home, the daily had an open, high, low, close right here. And we actually came up and we closed above the 6 p.m. open, right, that this candle chart's referring to. But with respect to the true day open, I believe we closed below it. Yep, we were closed below the true day open. So this daily candle, if this was the true day open, it would look like this, right? Open at midnight, high, low, and we come all the way up to it. Open, high, low, close. So that was the daily power of 3. So once you get a good alignment for where the market is tending, you can then use your 4-hour power of 3s, right? Or 1-hour power of 3s, right? Your CRTs, if you will, right? You trade the third candle once we close and we sweep this candle. Or you trade the third candle here. It doesn't matter as long as you understand, right? You trade the third candle here, right? This candle sweeps and it closes back in the range. So you can trade this third candle expansion, for example. It doesn't matter as long as you understand that the order flow has to be aligned at the right time. And if you are trading in the AM session, going long here doesn't make sense. Which is why on a bullish day, just because price action is bullish, doesn't mean we have to go like this in every single day. Like form a little retracement in London and expand all day. This is the day of the week. It's Monday, right? If we want to expand higher on the week, we will need to offer a weekly wick. Weekly wick. That means that the daily candle must engage some sort of PD array of interest at the lows. So we must do something like that. So as you see the low get put in, then you see the confirmations. That gives you the confidence, right, to long in here against this order flow. Because many people will short this for another leg lower. But you don't need to because you recognize that this distribution lower is a function, right, of the manipulation that is required to eventually move higher on the day, on the week, right, and on this next 4-hour candle. And you can see, right, that same logic applies to all the indices with ES leading the strength. So yeah, that was today's price action. It was extremely interesting because it was great short and long opportunities offered. As I usually suggest, it is better to align yourself with the higher time frame. So in my mind, the short here is not the trade I would prefer to take. I would rather see this as a original consolidation of the market. I would rather see this as a smart money reversal on intraday time frame. And I would much rather trade this move from internal range to external range on the hourly, which is aligned with my weekly candle, which is aligned with my daily candle, right? The daily is coming back into the range. The weekly is expanding at this point in time, higher. And then this next move on the 4-hour chart, which would be the 2 p.m. power of 3, is what I want to trade, that fractal. And not to say that one is better than the other, it's just what I would prefer to trade because this maps to my higher time frame order flow. And I see really nice smooth edges up here, right? So you could have seen the smooth edges on the sell side. Great trade. You know exactly where you're targeting. Fantastic. You're not holding to these lows because you're not expecting those lows to be taken. Or you can say you want to align yourself with the daily candle direction and then wait for it, right? The daily candle did this. It offered you exactly what you want to do if you were patient. If you were patient, the daily candle offered you this. Wow, my magnet's on, so it's not drawing properly, but the daily candle offered you this, right? Which was a really, really nice open, high, low close. And there was opportunities in here to go long, and there was opportunities in here to go short. And as long as you understand where you want to position yourself, both sides of the market can take good trades. And you wouldn't have been surprised by seeing the daily closures, right? Because again, at the end of the day, these daily closures are telling us a whole story. Closing above the inversion, right? Here, we're still inside of this SIBI, so we have to be wary. Closing above the consequent encroachment of the inversion, and we can expect right now higher prices still. Okay, so that was the daily recap.